Chapter 22, Bonds and Interest Rates. Before we get to technical analysis of stocks, let's finalize bonds. Although they offer lower returns, bonds are terrific diversification tools that secure your portfolio as you approach retirement or a savings deadline, and they offer much better returns than cash equivalents. You can use bonds to grow your money with very little energy or management, protect yourself from passive losses in the stock market that you may not have enough time left to get to back up after an index downturn, guarantee investment income levels rather than relying on changing stock dividends if you need spendable investment income, and supplement your portfolio as the first start investing in stocks to protect against a few failed trades. To better understand bond issues, let's look at the return of $100 in 1927 before the Wall Street crash of 1929, invested in the S&P 500, a virtually risk-free 10-year treasury bond, and a mixed weighing of both. As we talked about earlier, treasury bonds are guaranteed by the full force of the U.S. government and buyable through Treasury Direct. Then we see a graph shows the cumulative return of investing $100. And in the long term, the S&P outperforms, whereas the 10-year Treasury has the lowest performance, and the 50-50 weighting's right in the middle. In the beginning, the S&P went down the most, while the Treasury return stayed up the highest, and the 50-50 weighting dropped in the middle. From highest to lowest final return, we see the S&P 500, 50-50 weighting, and the 10-year Treasury. Notice that your money in the first decade or two dropped as the overall stock market fell. However, also remember that you continue to purchase shares as the market falls in monthly intervals as you accumulate investable income, therefore decreasing your average order fulfillment price and increasing long-term profits. This principle is especially true for broad market indices that account for price movements of many stocks. So, why invest in bonds? Notice that the equally weighted Treasury stock portfolio lost significantly less cash in early market pullback. If you are planning to send your kid to college in the coming years, then this pullback could be detrimental to their college fund, whereas a portfolio with bonds retains most of the capital through the pullback. Similarly, say you were retiring in 1930. With a market crash, you may not have 20 years to wait for the market to come back up. By weighing your portfolio in bonds, you limit your downside and protect your retirement money in its final stretch. Now, in the long term, the S&P 500 significantly outperformed the bond and stock portfolio. When you have the luxury of time to invest, stick with higher yield stock indices and supplement your gains with active trading to outperform the market when you find time and opportunities. S&P dividends alone often rival some bond portfolios. Once you start investing in bonds, consider expiration dates, credit ratings, and bond yield. Remember to follow diversification principles just as with stock so that one single loss in the bond market will not greatly affect your overall portfolio. We'll talk about diversification in Chapter 35. With traditional bonds, you lock your cash up with an entity for a predetermined amount of time. Then you get paid usually biannual coupons that return a percentage of your money that you lent the entity. This happens over and over until you get to the expiration date specified on the bond. At last, you can receive your last interest payment depending on the time frame, and the borrowed entity returns your full initial investment. This investment, no matter how long the bond lasted, will be in current dollars, so you'll be affected by inflation just like your regular coupon payments. You pay investment interest income tax on your coupon payments, but pay no taxes when your initial investment is finally returned. As alternative, lesser used type of bond is a zero coupon bond. In traditional bonds, you pay the face value of a bond, and you make your money off the coupon payments since you are paid back the face value at the expiration date. In a zero coupon bond, you pay less than the face value of a bond, essentially buying it at a discount. As you near expiration date of the bond, its value theoretically increases since you receive a face value payout at the end. However, a zero coupon bond pays no coupons, so you get the same bond-like return from your investment without actually receiving periodic payments. As for taxes, you must pay interest income on the theoretical annual increase of the zero coupon bond, even though you receive no cash from the borrowing company. The amount you pay for a zero coupon bond can be found using price equals maturity value divided by (1 plus 1/2 annual yield, end parentheses, to the power of twice the number of years until maturity. So a $1,000 zero coupon bond that matures in 3 years that yields a 10% annually will cost $1,000 divided by 1 plus 0.05 to the power of 6 equals $746.22. For this bond, you'd pay investment interest income on the 10% yearly increase in the theoretical value of the bond. We'll talk more about why you might want to use a zero coupon bond soon. Note that corporate interest income, not dividend, is included in your gross income and therefore taxed at your income tax bracket. As of writing this book, the bond market credit rating system is fairly centralized. The big three credit rating agencies, Standard & Poor's, Moody's, and Fitch Group, collectively control around 95% of the global credit rating market. Because of this oligarchy-controlled market, take credit ratings from these companies very seriously when considering a bond. The three corporations use the following rating system, going from best to worst corporate creditworthiness. Note that numbers and symbols are also added to further classify bond ratings. Standard & Poor's and Fitch use plus and minus signs. For example, A plus is better than A or A minus. And Moody's uses numbers where Baa1 is the best BAA rating, followed by Baa2 and Baa3. From Standard & Poor's and Fitch, we have the best ratings at AAA to AA to A, and then it goes down to BBB, BB, and B, and the worst would be CCC, CC, C, and then D. For Moody's, it's very similar, just a little bit different capitalization, and the ending is AAA, AA, BBB, BA, or BAA, BA, B, and then CAA, CAC. You can use credit ratings as one factor. You consider how likely a lender is to default on you. Remember, bonds are simply debt instruments wherein you lend money to a company that promises to pay you back their initial capital plus interest. Corporate obligations to bondholders, generally made twice a year, are paid before any cash is distributed to shareholders. The only way you can lose money directly with the bond is for the underlying company, organization, municipality, or government to default on its debt and stop paying you. In other words, go bankrupt. Credit ratings are a professional organization's opinion on how likely a borrower is to go bankrupt on you. Since most high-returning bonds are corporate bonds, we'll focus on these for creating bond income. This is not to say that you should avoid municipal or government bonds. Jump at good opportunities to get a high return in either of these bond categories, and you are in the market for bonds, and the borrower is in good standing. However, most municipalities and government offers lower returns because they often guarantee their bonds with the full force of the underlying government. Corporate bonds, on the other hand, carry greater yet still small defined risk, therefore offering higher returns in the form of bond yields. According to the big three, investment grade bonds are rated at least BBB- or Baa3. Anything lower than these credit ratings are junk bonds that will pay much more to borrow money from investors because they carry higher default risk. Investment grade bonds are more qualified to borrow thanks to their ratings, but you should still perform basic corporate financial analysis before lending to a company. Ask yourself, does this company have more assets than liabilities? Does this company bring in enough cash to pay its debts? Look for companies that bring in 4 times their interest payments to be safe. Any income under 2.5 times interest payments can be risky. Can the company sell assets to pay its debts in a business downturn? How established is this company? Simply put, make sure the company you lend can pay you back with interest. Try to find a good balance between highly rated but low-yielding companies and poorly rated but high-yielding companies. You want to exceed average bond returns without taking on too much default risk. Feel free to invest in a junk bond to get a higher return if you find a company with great financial reports or perhaps one you know of. Just remember to keep your positions diversified in case of default. See Chapter 35. Credit ratings and financials are both great, but you ultimately just want the highest return possible without too much default risk. If you are investing in bonds near the end of a stock market cycle, as shown through high chartable patterns, abnormally positive public stock perceptions, and inverted yield curves, try to buy bonds in a more highly rated companies, as a recession can bankrupt less established companies that have no longer serviced their debts by selling assets, liquidating inventory, etc. We'll talk about inverted yield curves soon. Likewise, you may be able to get away with a few very high return bonds in a booming economy. Just remember that you are looking for bond returns with bonds and specifically bond funds, which we will explore soon, alongside buying bonds at a discount in search of extraordinary individualized gains. Corporate bond yields depend on risk associated with the underlying company and macroeconomic factors. Since yields constantly change, your locked-in rate could be great one month and poor the next, depending on the bond market. This book was written in a low interest rate environment. In many years before this book, such as 1927 to 2000, example earlier, Federal Treasury bond interest rates peaked at 15%, while inflation rates peaked between 10 and 20% in the many years due to political and worldwide economic tensions. Values and rates for all bonds depend directly on the Federal Treasury interest rates because the U.S. government borrows so much money. Periodically check the Treasury bond rates when you invest in bonds, even if you're only investing in higher yielding corporate bonds or perhaps a corporate bond fund, as the Treasury's increasing or decreasing rates affect the entire bond market. Additionally, higher rates can fuel a growing stock market, emphasizing that you ought never completely leave the equities market, even when you approach a savings goal for retirement. See Chapter 35. Even in a market crashes, corporate bonds default rates increase as companies fail. If you do not have time to wait for the market to correct, bonds provide a cushion of promised income with priority payments in any corporate liquidation. With that said, try not to focus too much of your portfolio on bonds, if any, before closing in on your retirement or savings goal deadline if possible, unless you actively manage your bond positions, which we'll explore soon. You can outperform the bond market by keeping logical positions in the market and not making rash selling decisions after rapid downturns when you know the underlying companies you're investing in are valuable. Additionally, bond rates tend to drastically increase in crashes, making existing bonds less appealing to new bond investors who can access higher lending rates. This interest rate risk affects all bonds, as the rate corporations will pay for bonds slowly changes. To mitigate this risk, let's run through a quick example. Let's say you're 66 and you just retired. You know you will live a long and prosperous life, so you decide to leave most of your assets in stocks to appreciate and pay you dividends. As the market moves extremely high one year, you decide to start taking gains and rebalancing your portfolio into bonds. You do not want to take too much money out of your outperforming stock market, but you want to protect yourself in case of a downturn while also earning a modest return over inflation. Say you put 20% of your portfolio in bonds. As you grow older, you may spend part of your overall portfolio during retirement and move into more safer bonds. 30% one year, 37% another. Maybe you get to 45 as markets rally. The percentage you allocate into bonds depends on how you see the overall market. If you have made significant gains, it might make sense for you to take a little money off the table if you see limited upside in the coming years. Try to make planned logical decisions, hopefully based on technical analysis, about when to sell some of your individual stock positions. For reference, it took 3 to 5 years for the S&P to recover from the 2008 housing bubble, 7 years to recover from the dot-com bubble highs, and 2 years to recover from the stock market crash of 1987. However, much larger depressionary movements crippled the Dow for over 2 decades, and the crash and subsequent depression of 1929. Analyze general economic conditions around you when approaching your deadlines to determine how much your portfolio should be in bonds. If you are comfortable leaving cash in the market for the next decade, then you might not even need bonds. By further using the technical analysis skills in part 2, you can reveal timely opportunities to avoid and adapt to temporary market pullbacks. Everything comes down to your risk tolerance. Besides the basic percent return guaranteed by government bonds, consider the Treasury's yield curve to analyze potential future macroeconomic market movements. Here are the 3 yield curves you may see. Since you primarily use bonds to protect your money as you near the end of retirement savings or savings goal rather than long-term investments, you can usually just focus on shorter-term interest rates to predict how much they will affect your corporate bonds. However, as you said earlier, these yield curves reflect overall market conditions and can act as influential indicators in the stock market, since they represent the percent return the government guarantees depending on how you loan out your money. Then we see a flat yield curve as the percent yield stays the same as maturity increases. A normal yield curve, as the maturity increases yield. An inverted yield curve, as maturity decreases yield. In a normal yield curve, you get paid the most for locking your money up with the Treasury for longer time periods and receive lower returns for lower time periods. This yield curve represents economic stability and shows positive future outlooks for rising interest rates. This is a normal yield curve that investments in any bond should follow. Even with higher expected future value interest rates, the Federal Treasury very carefully adjusts its rates to find an equilibrium between supply and demand during good economic times. Treasury yields rarely stay flat, as flat curves in which the short-term and long-term bond rates are about the same. Rather, this yield curve acts as a precursor to a relatively swift movement to a normal yield curve or an inverted yield curve. In an inverted yield curve, short-term interest rates exceed long-term rates, disproportionately rewarding less time-committed investors. When this happens, investors think that long-term bond outlooks are poor. These outlooks suggest that long-term bonds will continue to decline in value because interest rates will decrease, to say the least. Inverted yield curves have preceded almost every American recession. They are one of the strongest indicators of incoming economic troubles because of their consistent history of foreshadowing market recessions. Perhaps one inverted yield curve in the 2 and 10-year Treasury bonds has been a false indicator in the past half century in the mid-1960s. Here are the most recent stock market recessions, all prefaced by inverted yield curves. On the left, we see the date when the 2-year and 10-year U.S. Treasury yield curve inverts. Then we see the recession start date and the months from the recession, inversion to recession, and the S&P return from inversion to recession. There's one in 1978. Crash was in 1980. September in 1980. Recession starts in 81. December 1988, recession starts in 1990. In those three, you had pretty solid 17, 10, 19 months, and then solid 9, 4, 28% gains in the S&P. Then in 1988 to 2001 and 2006, 2008, about 34 and 23 months from the inversion to recession, with 6 and 14% gains. If you look at the median statistics from this data, it's about 19, 20 months from inversion to recession with a median return of 10%, and then an average of 21 months from inversion to recession with a median return in the S&P of about 13% from that time period. So, watch out for inverted yield curves. After around 20 months from the first sign of an inverted yield curve, the stock market has historically entered a recession. This gives you time to assess the economic situation at hand and plan your asset movement into safer investments. There is still high potential gains to realize in the months before the market peak after you recognize an inverted yield curve, as shown by the average 12.7% S&P 500 return from inversion to recession. The above data looks at the 2 and 10-year Treasury bonds. These are great reference points when identifying yield curves, but you should not worry too much about looking at specific yearly Treasury bond rates. When you see an inverted yield curve, you will know it based on overall market rate trends. You can check Treasury rates in Yahoo Finance under the Markets tab. Notice that this trend is a much less prominent indicator in foreign government bonds. As you know, bonds are simply companies taking loans directly from investors. Bond certificates are traditionally much less liquid than stocks. Stocks trade in both primary markets and secondary markets. In the primary market, a company sells its shares in an initial public offering to directly raise cash based on current enterprise valuations. Similarly, companies sell bonds to investors in the primary market to raise credit. In the secondary market, investors buy shares of a company from current shareholders who sell the shares to other investors. Rather than the underlying company getting paid, the previous shareholders liquidates their position for cash. This secondary market for stocks is where almost all trading takes place on exchanges internally via dark pools, as we discussed in Chapter 37. Essentially, any company that has any historical price data on Yahoo Finance has its shares traded on the secondary market between investors and corporate shareholders. Because stocks historically create wealth much faster than bonds, demand in secondary markets, stock markets, for example the NYSE, the LYSE, NASDAQ, generate much more trading volume for stocks. Secondary bond markets are therefore less liquid with higher spreads, as explored soon, and greatly affected by federal interest rates. As you know, Liquidity is key for financial transactions. When you get stuck in a trade, the market forces you to either wait for your limit order to get filled on the ask as you anxiously watch the price move back and forth, or sell quickly to the bid and lose potential gains in the bid-ask spread. This liquidity is especially important for because, unlike stocks which are listed on major exchanges, bonds are only currently traded secondarily over the counter. OTC markets also include cheap and otherwise uncredible companies which from time to time create great 9 to noon trades. We'll talk more about identifying these volatile tradable stocks in chapter 36. If you want to sell a bond before its maturity date, you can sell it in the secondary market to a new investor. Market interest rates affect a bond's value over time in the secondary market. This creates interest rate risk when you look at the value of bonds sold before their expiration date. If federal interest rates rise, then the market value of your bond decreases. If rates lower, the value of your bond increases. Let's look at this in the market. Say you purchase a diversified portfolio of 5-year bonds yielding an average of 4.5%. In the current market, Treasury bonds yield around 3% annually. Your portfolio is doing very well in corporate bonds. The individual bonds that make up your portfolio should be marketable around their purchase price or slightly above it. As an individual investor, you can find the best value or growth bonds, just like in stocks, by buying individual bonds at discounts and selling them at their premiums, as shown below. And we see the pricing of investment grade bonds on a sample of about 1,963 bonds, and the offer price would be the percentage of the actual stated value that is being charged. So the bottom 10% are at a discount, less than 100% of value, and then most of them are around 100% to 110% premium, and then there's about 52% that trade at 110% or greater of a premium to investors. So when an investor buys the bond fund, they're effectively buying bonds at a premium, since the funds own hundreds of bonds, most of which trade well above par, as they have to buy pretty much all the bonds in the market. And then you see the number of bonds in the sample for pricing of investment grade bonds. Only including bonds with at least a 3.5% yield to maturity. The yield to maturity is an annual percent coupon rate which represents the total anticipated return of a bond if it is held until maturity date. Since you can individually pick each bond you purchase, you can spend time searching for and purchasing underpriced corporate bonds in the secondary market, which you have increased yields due to interest rate changes or trading discounts. In other words, you can make much larger profits than normally. Secondary market bond values depend on public corporate perception, just like stock prices, so lower earnings and higher debt obligations with declining growth prospects can cause bonds to trade at discounts because investors fear defaults. However, these temporary discounts and premiums are only realized if you buy or sell a bond before maturity from or to another bondholder. If you hold a bond to maturity, you will receive its full nominal value when your principal is returned in full per the bond expiration agreement. You can take advantage of secondary market opportunities by buying bonds from reputable companies with reasonable maturity dates that hopefully ladder into your overall portfolio. With both high coupons and strong discounts, as you look at a bond's bid and ask provided by your broker's feed and created by market buyers and sellers, just like in equities, you can see a bond's discount or premium represented as a number above or below 100, which simply represents the price you pay relative to the bond's face value. If you purchase individual bonds and search for consistent high-yield returns, follow our outlined long-term diversification principles in Chapter 35. Watch for companies that may have extremely large debt services requirements due to large debt leverage, creating a higher default risk. Now, let's say market interest rates fall to 2% for federal bonds in a year. Your portfolio is worth more in the market this year because borrowers now expect to pay an average 1% or so less to borrow from investors, since the market supports 2% treasury bonds. Since lenders generally have access to lower yielding bonds, you can sell your bonds before expiration date in the secondary market for a profit and realize your principal gain immediately. Sale price depends on current market rates and bond length, as we will discuss soon. Just remember, rates up, bonds down, and vice versa. However, you will also realize the bond's full secondary market value if you hold it to maturity. Selling your bond early simply allows you to capture gains immediately, whereas you will realize losses immediately if markets rise. These constant ups and downs in interest rates are unrealized in the nominal value of your own bond portfolio, but they cause bond funds to fluctuate. In fact, funds can lose market value despite a lack of underlying bond bankruptcies because mutual fund managers are forced to sell open positions to pay for fund holder redemptions. Bond ETF management firms also distribute or acquire creation share blocks that terminate existing bonds and acquire new ones before bond expiration dates. See Chapter 17. These early redemptions change the net value of a fund's asset, even though the bonds are supposed to be a stable, fixed income streams. To understand this principle, let's look at the historic performance of three relatively conservative bond funds that all invest in U.S. Treasury bills. We see here three funds, pretty much all the same movements on the graphs. From highest to lowest final percent return, ignoring dividends, we see the Loomis Sayles Core Plus Bond Fund, Vanguard Total Bond Market Index Fund Investor Shares, and Fidelity Total Bond Fund. Notice that all three of these funds constantly fluctuate and generally trend sideways. If you buy a bond, your primary return come from dividend payments, an income stream unshown in direct stock charts. At the time of writing, the three funds above pay an average 3% yield because federal treasury interest rates are currently around 3%. To get this return with very little risk and significantly less nominal volatility, you could simply buy treasury bonds. A similar mentality applies to investment-grade corporate bonds, but you must diversify your portfolio with long-term holding percentages, see Chapter 35, because these positions carry default risks. Bond fund net assets fluctuate because the constantly close positions before expiration in secondary markets, realizing nominal interest rate value changes before expiration. Individual funds should tell you how long they hold an average position for alongside their average bond expiration length. Check the management firm website. Funds with mostly short-term bonds are less affected by interest rate changes because their positions will quickly close, allowing the fund managers to constantly reinvest capital into new bonds, paying newfound market rates. If interest rates rise, then shorter-term bond funds ought to perform better than long-term funds because they can more readily invest in higher market rates with increased capital liquidity. Likewise, decreasing interest rates can cause these funds to decrease in value, reflecting by changing net asset values and market perception. The more deviance from NAV for bond mutual funds because of ETF share redemption practices mentioned in Chapter 17, which enable arbitrage to maintain a stable and orderly market. However, if you hold any bond fund for the long term, you should worry more about your percent dividend yield, which reflects your overall bond return and investment income. Contrarily, interest rate changes more significantly affect long-term bond funds. If the fund in question has a particularly long average holding period or bond expiration lengths, then you can get stuck with old market interest rates as new bonds are paid more for capital lending. These funds can also lock in exceptional interest rates for the past before new market rates drop to maintain strong long-term growth and dividend payments. Consider the overall market interest rate environment you're investing in alongside available market funds to find a blissful equilibrium in your bond fund portfolio. Bond funds differ from personal bond portfolios because you can temporarily lose nominal value because of interest rate changes. The following reference data may help your bond investing. And then we see a long-term chart of inflation, treasury yields, and corporate bond yields from 1953 to 2019. Percent yield kind of maxes out at 15% as the rates went absolutely berserk in the 1980s, and then they've just been consistently decreasing since that peak. And we see inflation, and then a bunch of corporate bond funds, corporate bond yields. So those are just collections of bonds, and then treasury yields, which are all the same, and high quality corporate market bond yields. From highest to lowest final percent yield, we see the Moody's seasoned BAA corporate bond yield 20 plus year expiration, the Treasury high quality market corporate bond yields for 20 years, Moody's seasoned BAA corporate bond yield for 20 plus years expiration, 20-year Treasury constant maturity rate, and CPI-U inflation yearly changes. Expect shorter-term bonds to reflect these trends but with lower percent coupons. Notice that bonds with higher default risk tend to pay higher yields. We are in a historically low interest rate environment with a very stable economy. As rates recently increased, bond funds often decreased, while individual investors simply reinvested their coupons at higher market rates with no nominal decrease in portfolio value. While you may incur temporary losses in bond funds because of interest rate changes, your overall volatility will almost always be much less than that of stock indices. Stock indices may decrease 50%, whereas quality individual bonds never default, and bond funds drop by 10%. In your bond portfolio, you can minimize all interest rate nominal volatility by researching your own positions and creating your own diversified portfolio to outperform the market. Just like with stocks, however, bond funds do have some competitive advantage over individual investors in current centralized bond markets. Aside from your individual ability to buy bonds at discounts, as we discussed earlier, bond funds have greater leverage with individual lending entities to initiate new bond positions from the marketplace. To understand this unique bond fund position, let's explore spreads in generally liquid and higher fee corporate bond markets. Then we see corporate bond bid-ask spreads by trade size and the percent of par. And so the greater the trade size, the lower the spread as a percent of par, and therefore from highest to lowest final spread percentage, we see micro under $100,000, odd lot $100,000 to $1 million, round lot $1 million to $5 million, and block above $5 million bond trading sizes, volume weighted spreads. And you can see a significantly larger spread as you go down to micro or smaller individual investments in corporate bonds. Because bond funds create diversified portfolios with millions or billions of pooled investor dollars, they can access much lower spreads in corporate markets than individuals diversifying with relatively smaller portfolios can. These higher quality spreads increase long-term returns due to a lower cost basis at the cost of often underrepresented secondary market bond discounts. Especially when considering the additional task of finding and managing individual bond positions, bond funds can streamline your investing as you near a savings or retirement goal. On top of this bulk order advantage, you can buy or sell bond funds at any time in liquid ETFs and mutual funds. Your capital is not locked into any set bond expiration date, so you do not have to directly sell any unexpired bond to another investor, potentially with a large spread. The fund does this for all investors or simply exchanges ETF shares. Bond ETFs and mutual funds are an easier way to enter the bond market with automatic diversification, lower research requirements, and minimal transaction fees. Consider bond funds as you enter bond investing if you value high capital liquidity and can withstand short-term losses with long-term dividend payments. Most bond investors are nearing retirement or a large savings goal since their cash is not in the historically higher yielding stock market. Because of this, bond investors tend to have relatively large positions, and changes in market interest rates can significantly affect the market value of your position. In fact, some record changes in federal interest rates in basis points to track small movements in market rates. 1 basis point is 1/100% or 0.01%, 0.0001. These small measurements increments highlight how much interest rates can affect the value of your bonds. To mitigate interest rate risk, you can ladder your bonds to give yourself constantly investable capital. Rather than purchasing 20 bonds that expire in 7 years, you could gradually enter and exit your bond positions. In this example, you could choose to purchase 3 1-year bonds, 3 2-year bonds, 3 3-year bonds, 5 4-year bonds, 5 5-year bonds, and 1 7-year bond. With this financial planning, you can reinvest your shorter-term bonds at market interest rates once they expire. This will protect your investments and keep them liquid without selling on secondary markets, since your positions will systematically reach expiration dates over time. When you go to reinvest your cash after expiration, you can purchase bonds in the market again. If interest rates rise over the holding period, you can take advantage of high rates with new bonds that expire closer to your target retirement or savings goal deadline. If interest rates lower during your holding period, then you can reinvest coupon payments in the short term, knowing that your older, longer term bond yields higher average interest rates. Laddering your bonds' expiration dates provides you with more capital liquidity and gives you upside in rising interest rate environments. However, you may miss potential returns in a lowering interest rate environment. Consider the overall trend of federal interest rates when considering how aggressively to ladder your bonds. Long-term trends shown 2 graphs ago. Now rising shorter-term rates were recently near 0% as the government recovered from the 2008 financial crisis. Bonds are terrific investments to decrease your risk while still providing tangible returns. However, liquidating a position before its expiration date may yield a loss depending on market interest rates. When you create a bond portfolio, just like with most stocks, ensure you will not need the money you invest for any immediate expense or emergency. The last thing you want to do is sell at an inappropriate time in the secondary market for a loss. Bonds and bond funds in particular often slightly boom when the stock market booms and slightly bust when the stock market busts in terms of average default rates. Tough times force lower quality companies into bankruptcy and present unprecedented buying opportunities as stocks go on sale. We will look more diversification in Chapter 35, but always try to balance your stock and bond risk exposure as interest rates change. Lastly, we get to callable bonds. If you are ready to invest in bonds, this relatively niche term will help you identify and evade hidden call risks in the bond market. I have greatly elaborated on callable bonds on my YouTube channel in a concise video that will tell you everything you need to watch out for to avoid potential losses when you face bond issue companies. You can find this video by searching John Wooten Callable Bonds on YouTube. You can use zero coupon bonds to alleviate callable bond risk when a company refuses to remove a call clause since the bonds have a guaranteed final value.